Welcome to the Deep Dive, the quick-cut analysis for the experienced investor. We break down the earnings calls that matter.
Today, we're digging into Quest Diagnostics, ticker DGX, specifically their Q3 2025 results. And the story here is really quite interesting.
Yeah, there's this kind of disconnect, right?
Yeah.
Operationally, things look fantastic, but the market seemed, well, skeptical.
Exactly. That's the paradox we want to unpack.
So management delivered clear beats, raised the guidance for the full year pretty substantially, but then the stock gets hit hard on the day. What gives?
Our mission today is really to figure that out. We need to pull out the key financial drivers, look at the big strategic moves. That Corewell partnership is huge, but also weigh the headwinds.
Things like PAMA, maybe the Project Novier spending.
Precisely. Those are casting a shadow. And we need to see if the market's maybe missing the bigger picture, the durable growth story underneath.
Okay, so let's start with the results themselves, the hard numbers. What were the wins?
Well, the numbers were, frankly, really strong. Adjusted EPS, $2.60. Consensus was hovering right around $2.50, maybe $2.51.
So a solid beat there, and the top line.
Same story. Revenue came in at $2.82 billion. The street was looking for maybe $2.73, $2.74 billion. So comfortably ahead.
And that translates into pretty healthy year-over-year growth, too. What were those percentages?
Yeah, really healthy. Adjusted EPS was up 13.0% year over year, and revenue almost identical, up 13.1%.
And crucially, they didn't signal a slowdown. They actually raised the guidance for the full year.
They did. Lifted the full year 2025 adjusted EPS target to $9.76, $9.84. And revenue guidance also got a bump, up to 10.96, 11.8%.
Absolutely. I mean, look at the organic numbers. Organic revenue growth was 6.8%. That's strong. And organic requisition volume, the actual number of tests, up 3.9%.
So not just acquisitions driving this, real underlying demand.
Exactly. It signals broad-based structural growth in demand for their clinical solutions. Okay, so here's where the tension comes in. All this positive news, beats, guidance raise, but the stock pulls back. It had been near its 52-week high just before the release.
Right. It really smacks of a sell the news dynamic. Or maybe investors getting nervous about valuation near the highs.
Or focusing on those headwinds we mentioned, short-term costs, regulatory stuff.
That seems likely. Which means our job here is to really assess the durability of this growth. Is the market overly focused on key four costs and missing the quality of this revenue stream?
Let's talk about that quality then. Total requisitions were up 12.5%. Is that sustainable volume? And is it actually helping margins?
It seems to be both, actually. The organic revenue per requisition was up 3% in the quarter.
Okay, that's a key metric.
It is. It tells you they're not just doing more cheap tests. They're benefiting from people getting more tests done per visit, and critically, a richer mix of tests, more complex, higher value stuff.
Which leads us straight to advanced diagnostics. That's usually the higher margin part of the business. What did we see there?
Momentum there is phenomenal. Double-digit revenue growth across several of those advanced clinical areas.
Anything specific stand out?
Brain health, for sure. Demand for their AD Detect blood tests for Alzheimer's, it more than doubled just in Q3.
Doubled. Wow.
Yeah. And that's getting a tailwind from new clinical guidelines that actually recognize these blood-based biomarker tests. It's becoming more standard.
And innovation elsewhere. Oncology is always key.
Right. Their Haystack MRD test, that's for minimum residual disease in cancer patients, it just received FDA breakthrough device designation.
Which is a big deal, right? It validates the tech and can speed things up.
Exactly. Faster regulatory path, potentially more use cases down the line. It strengthens their position. Okay,
let's shift gears a bit. Let's talk about the strategic pillar that maybe provides the best counter-argument to short-term market worries. Enterprise outsourcing. This is the long-term sticky revenue.
This is absolutely crucial for the long-term story, where the real visibility comes from.
And the headline act here has to be the Corewell Health joint venture. This sounds massive.
It is. It's the biggest implementation of their collaborative lab solutions. They call it collab solutions. Basically, Quest is taking over and running the lab operations for a major state health system.
Like outsourcing the hospital's entire lab function?
Pretty much. They're setting up a new statewide lab platform in Michigan, deploying their systems across all 21 of Corewell's hospital labs.
21 labs? And didn't management put a number on the potential revenue from this collab suite?
They did. They expect annual revenues from collab solutions to hit roughly $1 billion next year, just as it ramps up.
$1 billion from that kind of partnership model.
Yep. That is significant long-term contracted revenue visibility, the kind the market usually loves, but seem to overlook in the immediate reaction.
And they're doing something similar, though maybe structured differently, with Fresenius Medical Care, too.
Right. They finished acquiring assets there and started rolling out testing to Fresenius's dialysis centers. That's serving around 200,000 patients a year.
And they mentioned integrating that volume smartly.
Yeah, they're folding it into their existing labs during periods of open capacity, trying to boost productivity without massive new build-outs immediately.
Okay, and there's another growth area bubbling up, too, the direct-to-consumer channel.
Right, questhealth.com. That saw strong double-digit growth as well. It shows people are increasingly taking control of their own testing.
And it's not just their own website, is it? They're partnering with wellness brands.
Correct. Positioning themselves as the preferred lab engine, as they put it. They announced deals with WHOOP, the fitness tracker company, and URA, the smart ring maker.
Interesting. What does that WHOOP deal look like?
It's a specific panel, I think 65 biomarkers for $199. Management called these users the CEOs of their own health.
Catchy phrase. But is there a financial angle beyond just the revenue?
Absolutely. This consumer channel is a direct cash business. People pay when they order the test.
So no waiting for insurance reimbursement.
Exactly. It improves the cash conversion cycle, reduces collection risk.
Yeah.
That's actually quite valuable compared to the traditional, sometimes lengthy reimbursement timelines.
Good point. Okay, let's look at the profitability structure. Margins actually expanded, right?
They did. Adjusted operating income margin hit 16.3%. That's up 80 basis points compared to last year.
How are they achieving that?
A big part of it is their internal cost-saving program, Invigorate. They're targeting 3% annual savings and productivity gains. Think automation, centralization, network optimization.
So structural improvements, not just temporary cuts.
Right. It's necessary to kind of build a buffer against future pricing pressures, like PAMA, which we'll get to, makes the margin story more resilient.
But investors clearly got spooked by expected cost pressures, particularly in Q4. Let's break those down. What's hitting margins in the near term?
Okay, three main things for Q4 margins. First, Project NoVA. This is that big multi-year IT overhaul with Epic, the order-to-cash system transformation.
Using Epic Speaker, MyChart, the whole suite.
Right. And the investment costs for NoVA are really ramping up in Q4. The timing of signing the deal means a bigger chunk of spending hits now.
We just talked about that massive billion-dollar Corewell deal coming online. How much is Project NoVA tied to actually being able to handle that kind of scale efficiently?
That's the critical link. NoVA is the engine they need to integrate these huge, complex new clients like Corewell without breaking the system or killing margins. Management put a total price tag on it, didn't they?
Yeah, somewhere between $250 and $310 million total across OPEX and CAPEX over multiple years.
Because it's a hefty investment, no doubt, but it's arguably the enabling investment to digest that $1 billion in new revenue and keep things running smoothly.
Okay, so NoVA costs are ramping. What else is hitting Q4 margins?
Second, employee healthcare costs. They were higher than expected in Q3. Management said it impacted margins by maybe 40 to 50 basis points.
Ouch.
Yeah, and they expect those costs to stay elevated in Q4. And then the third thing is just normal seasonality.
Right. People use healthcare differently in Q4.
Exactly. Pre-COVID patterns usually show Q4 operating margins dipping maybe 50 to 100 basis points below Q3 levels, just based on utilization.
Okay, let's talk cash flow then. The year-to-date number looked fantastic. $1.42 billion from operations, up over 63% year over year. And they guided to $1.8 billion for the full year.
It does look incredible on the surface, but we need to put it in context for looking forward, say, into 2026.
Meaning there were some one-time items boosting that number.
Precisely. The strong performance this year includes over $100 million in non-recurring benefits. There was a $46 million CARES Act payment, plus some cash tax benefits from recent legislation on bonus depreciation and R&D expensing.
Got it. So if you're modeling out future cash flow, you need to normalize for those one-offs.
Absolutely. Strip those out to get a sense of the true underlying baseline cash generation power.
Okay, and the last big piece of the puzzle, the major regulatory uncertainty, PMA.
Right, the Protecting Access to Medicare Act.
Yeah.
This is the big one looming over the whole lab sector. It basically forces reimbursement cuts based on market data.
And the risk is that those cuts finally kick in next year after delays.
That's the concern. Management mentioned there's bipartisan legislation, the RESULT Act, trying to reform PAMA more broadly.
But they think just another delay is more likely than full reform.
That's what they signaled, yeah. A delay seems to have a higher probability right now.
So what's the damage if PAMA does hit next year without a delay or reform?
Management quantified it. They expect about a $100 million hit to the P&L if those cuts come back.
$100 million. That's not insignificant.
It's not. But, crucially, they also said they can offset part of that impact. How? By controlling the timing and pace of investments.
Like maybe slowing down some of the Project No VA spend if needed.
Exactly. They have some levers to pull. And perhaps more importantly, those invigorate productivity gains we talked about. Those are structural savings designed in part to help absorb exactly this kind of regulatory pressure.
Okay, so pulling it all together. We have a company firing on most cylinders operationally, posting great numbers, raising guidance, but the stock gets punished, likely on fears about Q4 costs and PAMA.
That's the setup. Strong underlying business quality meets sell the news jitters.
Which brings us to our not financial advice segment. What's a plausible trade idea based on this disconnect?
Well, this setup seems tailored for an investor who can look beyond the immediate Q4 noise. You've got clear execution against major growth trends, advanced diagnostics, consumer access, and especially that huge enterprise outsourcing piece.
But the stock's trading on near-term cost ramps and regulatory maybes.
Right. So the plausible trade idea here is to actually buy DGX, use this pullback as an entry point for a long position.
And the rationale is?
The rationale is basically that the market seems to be dramatically undervaluing the visibility and the sheer size of that billion-dollar-plus revenue stream coming from scaling up Corewell and integrating Fresenius.
So the market is focused on the $100 million PAMA risk and the Q4 no VA costs.
And arguably ignoring the $1 billion in highly visible contracted revenue that fundamentally changes the valuation math looking out to 2026 and beyond.
And the view is that the PAMA risk, while real, is manageable.
Yes. Between the invigorate savings and the flexibility to adjust the timing of Novia spending, that $100 million hit seems absorbable. It makes the current entry point look pretty attractive relative to the potential free cash flow in 2026 once these big contracts are fully ramped.
Okay, so to quickly recap this deep dive, Quest delivered strong Q3 beats on earnings and revenue and significantly raised full-year guidance.
They're executing on major new partnerships, that huge Corewell JV targeting $1 billion, the Fresenius volume integration, and new consumer wellness tie-ins with WHOOP and URA.
All while seeing continued strength in high-value areas like the AD Detect Alzheimer's test and getting recognition for innovations like Haystack MRD and oncology.
Definitely. And maybe the final thought to leave you with, it centers on that Corewell deal. It really does create a new template, a new model for how these big lab companies can partner with large health systems. They're essentially offering to take over the entire hospital lab function.
So the provocative question is,
what's the real long-term value creation potential here if this $1 billion collab model isn't just a one-off, but becomes the industry standard for how hospitals outsource their labs across the country? If Quest can replicate this, that fundamentally reshapes the market.
That is definitely something to think about. And just a reminder, everything discussed here today is purely for informational purposes. It is not financial advice. Please do your own research.
Thanks for joining us for this deep dive. We hope you found it useful, and we invite you to continue the conversation.